strong hiring, strong income growth, healthy savings, and confident households, then higher gas prices might have been absorbed. But that wasn't the backdrop. Consumers were already in trouble to begin with. Savings cushions were thinning. Credit cards, they had been used and then some. The labor market was already displaying signs of weakening beneath the headline payroll numbers that were not actually good to begin with. Housing was already stuck in a multi-year slump. Retailers were already dealing with the trade-down behavior. Then gas prices jumped. That's why Pepsi's data matters. The beverage volume decline may sound small compared with something like GDP or the last couple payroll reports before June's, but it's immediate. It captures the moment when a household walks into a store and decides what goes in the cart and what goes back on the shelf. Pepsi's telling us more than a lagging economic model that they use at the Fed. It's telling us consumers are in worse shape than they expected. And when Pepsi says the problem is mainly gas prices, that doesn't support the Fed's inflation obsession. It undermines it because the consumer response to higher gas prices isn't no problem, we're going to keep paying for everything. The response has been, we've got to cut back and cut back in a lot of different places, which shows up in soda volumes, smaller retail baskets, on credit card balances, in home sales, in home prices, and a whole lot more beyond it. That's not a resilient consumer economy. It's a weak consumer economy getting even weaker. So the Pepsi earnings report is not just a corporate story. It is a warning. North American beverage volumes fell 4%. The CEO said consumer is worse than expected. Gas prices are the main proximate driver. Consumer credit fell sharply in May. Revolving balances dropped by the most in almost 2 years. And home sales, existing home sales, resales, they missed yet again. Home prices softening. And of course, retailers and changing their behavior, shrinking transaction size and selling miniaturized goods because consumers are avoiding anything that looks like a big commitment. All of this fits together. The economy is not showing broad inflationary strength. It's showing demand destruction caused by an energy shock hitting an already fragile consumer with fading job prospects. That is the story. While the Federal Reserve is still obsessed with inflation and likely to trichet itself over it, Pepsi, credit cards, housing, home prices, the changing behavior of retailers that are responding to changing behavior of consumers, all of it tells us the same thing. Consumers aren't buying beverages. They ran headlong into flat beverage. If you like this video, I've got another one for you where I go over exactly what I do here at Eurodollar University and why, my methodology, where it came from. Why do we focus on all these esoteric signals when the mainstream doesn't? When the mainstream should. Why doesn't the mainstream focus on them? We went over that as well in this video. Plus, at the end, and go over how to use this information in a portfolio management and investing context. That's the video I've got linked on the screen.